Good morning, everybody, and welcome to May. We are slightly changing the current format for the webcast to make it ready for audio-only format, as we are preparing to launch it on the more general available podcast platforms too. As such, we won't be having graphs or other video formats here. Today the machines are looking at Magna International, Honeywell, Chevron and Exxon Mobil. Magna International announced results on April 29, 2022. Interesting facts picked up from the call. The other piece, when you look at the BES group, we spoke briefly about our operations in Russia, and we disclosed that we had 371 million of sales in our Russia operations, and we've removed effectively what we've done as we have zero sales for Russia on a go-forward basis for 2022, and Russia disproportionately hits our desk segment as well. And then third, when you talk about the contracts going forward, we did have one supplier earlier who had expensive operations in Brazil talking about perhaps going to the South American model of just indexing everything, wages, free food in the cafeteria, and then sitting down with OEMs on a monthly basis and getting recoveries. Given that we see that the reduction in guide is largest in body, I'd assume that maybe it could be a timing difference and some of the raw material pressure could be coming in steel, but it seems like the comment just made was the majority of the 290 was utilities energy freight in Europe. So if you think of the most significant impact that's happened in the court is obviously the invasion of Ukraine and Western Europe, when you think about volume guidance in Europe broadly, we've taken out 100% of volumes in Russia for our customers for the balance of 2022. Here are some of the questions that were asked during the earnings call, to have a better idea of the discussions that were happening. Do you get the sense that there might be some building of inventories in the channel to the automakers where they're ordering but maybe not producing? I'm just curious if your conversations are changing there, and when you talk about that 290 million of higher input costs in your outlook, is that net or gross of these discussions? I don't know if labor is something incremental, and if we assume that cost inflation doesn't go away but that an improved production level comes in more stable production, maybe you can give us a flavor of what your earnings power is with higher volume, even in the face of higher cost inflation. Is there potential for significant improvement with higher LDP, even if inflation is what it is and it doesn't get any better? I just want to be clear, is it your going assumption that inflation as it relates to energy, logistics, etc., that is going to be more difficult to recover from your customers than straight commodity inflation? Last, we used sentiment analysis to see how the analyst call sounded about specific topics. About sales, the sentiment was 76% negative. About investments, the sentiment was 75% positive. About costs, sentiment was 90% negative. About growth, sentiment was 60% positive. About outlook, sentiment was 71% negative.
Honeywell announced results on April 29, 2022. Interesting facts picked up from the call. Global energy production continues to transition to a low-carbon future, and Honeywell will lead that evolution with our strategically differentiated and sustainable technologies. We expect supply chain impacts to remain as challenging in the second quarter as they were in the first quarter, but the start to abate as capacity for electronic components comes online in 3Qs. We're confident in the eventual return normalcy in the aerospace supply chain. Excluding the 30 basis point headwind from Continuum, we expect margins to expand 40 to 80 basis points second quarter net below the line impact, which is the difference between segment profit and income before tax, is expected to be in the range of $0 to $45 million, with a range of repositioning between $40 million and $80 million. Since we stood up our sustainability program in 2004, we've achieved every one of the ambitious targets we have set for ourselves, reduced our greenhouse gas emissions intensity by approximately 90%, while spending over $4 billion on remediation projects to restore thousands of acres of land for our communities. We expect that our disciplined price actions will keep us ahead of the current inflationary environment, contributing approximately 5% to our sales growth, which is higher than we anticipated in our original guide and offsetting the majority of the approximately $400 million of lost Russia sales. Here are some of the questions that were asked during the earnings call, to have a better idea of the discussions that were happening. And then within aerospace, was the Q1 margin performance in line with what you expected, and what's the conviction on that margin turning around through the year? And then on the positive side, anything that you're seeing or embedding on a pickup in defense or oil and gas in the second half of the year, or maybe is that stuff still out kind of in front of us? The first, can you just clarify maybe with a little more precision where you expect the aero margin to come in the second quarter, just to kind of clear the decks on that? And then also on SPS, the warehouse business, how does that trend kind of sequentially as we go through the year? And longer term question, how do you think about longer term impact of Russian oil having to find new markets? Last, we used sentiment analysis to see how the analyst call sounded about specific topics. About sales, the sentiment was 50% positive. About costs, the sentiment was 50% positive. About growth, the sentiment was 79% positive. About outlook, the sentiment was 75% positive.
Chevron announced results on April 29, 2022. Interesting facts picked up from the call. And so we want to set the buyback at a rate that we can manage it not only at our mid-cycle cash flow generation capability, but even when it goes below that. Again, there's going to be a time where we're going to be buying back shares, and we'll be doing it on the balance sheet because we'll want to re-lever back closer to that 20% to 25% net debt ratio range that I've talked about. First quarter oil equivalent production decreased 2% year-on-year due to the expiration of Rokan in Indonesia, lower production in Thailand as we approach the end of the concession, and lower entitlements due to higher prices. Permian growth in the absence of Winter Storm Uri impacts partially offset and drove U.S. oil and gas production up over 10%. Looking forward, I know that Chevron is doing its part, raising this year's Permian production outlook and advancing two important renewable fuel transactions, our Bunge JV, which is expected to close shortly, and the Renewable Energy Group acquisition, which is expected to close around mid-year. Downtime associated with the April repairs is estimated to be less than 15% of our second quarter turnaround and downtime guidance. We anticipate a return of capital between $250 and $350 million from Angola LNG in the second quarter. Wheatstone has a turnaround underway right now of one of the two trains and also the offshore platform and some common facilities, which that requires both trains to come down when you take the offshore and come in facilities down. Here are some of the questions that were asked during the earnings call. To have a better idea of the discussions that were happening, can you just maybe provide a little bit of commentary on how you're viewing the buyback in relation to mid-cycle cash flow? And also, when we're looking at your capex for this year, the Dungeon JV $600 million investment, is that included in your original budget or that this will be in addition to your original budget? How do you think over the next couple of years blending in your known deepwater projects and then the possibility of doing something again on the LNG front? I know you have weeks done in LNG maintenance in second quarter. Any kind of clarity you can give in terms of how much volume impact that might have, and beyond that, can you give an update or other potential volume disruptions across your LNG operations in the first quarter? Last, we used sentiment analysis to see how the analyst call sounded about specific topics. About prices, the sentiment was 66.7% negative. About growth, the sentiment was 54% negative.
ExxonMobil announced results on April 29, 2022. Interesting facts picked up from the call. Combined with carbon capture, transport and storage of approximately 10 million metric tons of CO2 per year, this facility will be a foundational investment in the development of a Houston CCS hub, which will have the potential to eliminate 100 million metric tons of CO2 per year and represents a meaningful step forward in advancing accretive low-carbon solutions. And so that really addresses our need for flexibility in what's an incredibly uncertain environment, and ensuring that we'll continue to appropriately invest in the business and sustain the share of purchase program that we talked about through 2023. In terms of just how to think about the pace of the program, it's up to $30 billion through the end of 2023. As you know, we are discontinuing our Sakhalin 1 operations in Russia, which represented less than 2% of our total production last year, about 65,000 oil barrels per day, and about 1% of our corporate operating earnings. As the operator, our priority continues to be the health and safety of our people and the protection of the environment. So you should expect, with the backdrop of these strong market conditions, that even with the higher buyback program that we announced this morning, we would be building our cash in the near term, potentially between $20 to $30 billion over time. Turning to structural savings, we continue to drive further efficiencies, now delivering more than $5 billion of annual savings versus 2019 capex total of $4.9 billion for the quarter, in line with our full-year guidance of $21 to $24 billion. Here are some of the questions that were asked during the earnings call, to have a better idea of the discussions that were happening. And I guess, do you intend to really look for a global outlet for a portion of your U.S. gas? Can you talk about how you see the evolution of the U.S. market, and how do you see certified gas playing a role in U.S. supply? Good things. Maybe one on capital allocation. As we think about your capital budget, not just for this year but over the next few years, and the range that you have within those budgets, should we think about that range as primarily driven by timing? Or is there a possibility that higher commodity prices, should we think of that maybe pushing towards the higher end of the range through some combination of inflation, Or are there opportunities in the portfolio to deploy a little additional organic capital? What percent of your capex is pretty much that have some pretty fixed pricing, and what percent is going to be subject to the inflation factor? Last, we used sentiment analysis to see how the analyst calls sounded about specific topics. About prices, the sentiment was 66.7% negative. About investments, the sentiment was 75% positive. About outlook, the sentiment was 66.7% negative.
I hope you found today's updates helpful. If you want to learn how to build your own algorithms, you can check our free YouTube channel where we post hands-on courses about how to build them, or get the book that is looking at multiple types of investment algorithms, or feel free to check our small group customized lessons for something more personalized.